Hello, Craig Deegan here, and welcome to our video on Chapter 25, which is looking at how we account for groups of organisations, group structures. Now, it's common for organisations to combine in the pursuit of common goals. Now, when we hear about the results of large organisations, what we often don't appreciate is we're actually hearing about the results of a large group. So, for instance, if you hear about the results of a big mining company like BHP, you're actually hearing about the results of many, many organisations all consolidated together. It's not just one separate legal entity, such as a single parent entity. You're actually hearing about the results of a group. Same as if you hear about the results of a big bank like the Commonwealth Bank, that its profits were such and such. That's actually the profits of the group, not just the one parent entity. So you need to appreciate that. Now, the purpose of consolidated financial statements is to show the results, the financial results and the financial position of a group of organisations as if they are operating as one single economic entity. So we change the focus. So now we focus on the bigger economic entity and we provide one set of financial statements for that economic entity, rather than perhaps giving 100 different financial statements for each organisation in the group. We consolidate them and as if it's one economic entity. Now, it's based around control. In terms of determining what organisations get included as part of the consolidation process, it's based on control. What happens with consolidated financial statements is we combine or consolidate the results of a parent entity and all the organisations it controls, and we call those subsidiaries. So a subsidiary is an entity that is controlled by another entity, which we call the parent entity. So a subsidiary is an organisation that's controlled. Now, where the parent entity or another organisation controls another organisation, that is seen to exist where there are rights that give the ability to that investor to direct the relevant activities of the investee. So if an organisation can direct the relevant activities of another organisation, then that suggests it controls that organisation. Now, in terms of some of the criteria to establish the existence of control, control generally exists when there's some power of the investor over the investee, and it gives the investor exposure or rights to variable returns from its involvement or investment in the investee. If one organisation controls another, it gives the controlling organisation the ability to use its power over the investee to affect the amount of the investment returns that the investor will receive. Now, control would normally exist when the parent entity owns, say, 50% or more of the ordinary share capital of the investee. That would normally be assumed to be control, but to suggest control exists. But realise you can control an organisation with less than 50% ownership of the ordinary shares. If the other shares are held by tens of thousands of people, they typically won't all come together to vote. So it's actually possible to control an organisation with less than half the share ownership of the organisation. Now, control can also be direct or indirect. For instance, assume we have one company, Company A, that holds 100% of the shares in Company B, and Company B holds 100% of the shares in Company C. Now, Company A controls Company B through a direct ownership interest, through direct control. But because Company B controls Company C, and because Company A controls Company B, through its control of B, it effectively also controls C. And we call that indirect control. It's nevertheless control, and Company C would still be a subsidiary of Company A, even though Company A doesn't have any direct control over Company C. It has indirect control. Okay, now, when we're accounting for business combinations, we apply the accounting standard AASB 3, or its international equivalent IFRS 3. So when one organisation acquires another business, that's called a business combination, and we apply AASB 3. Now, when we consolidate the accounts of a subsidiary, that's when we generally recognise what's known as goodwill. So what do we mean by goodwill? Goodwill is the excess of the cost of the business combination, what it cost at fair value, over and above the fair value of the acquirer's interests in the net assets and contingent liabilities of the subsidiary. So again, goodwill is the difference between the fair value of the consideration paid for the investment, and we compare that with the acquirer's interests in the net fair value of the identifiable assets, liabilities, and contingent liabilities. And if I'm paying more than the net fair value of that, I'm paying for something else that wasn't identifiable, and we call that goodwill, purchased goodwill. Now, we need to be clear about the acquisition date because fair values will change across time. So our calculation of goodwill will change across time if we substituted a different acquisition date. So we've got to be very clear about the acquisition date. Now, as part of the consolidation process, we might actually recognise some assets in the subsidiary that weren't previously recognised by the subsidiary. So, for instance, as we know, intangible assets can only be recognised for financial reporting purposes, typically if they've been acquired. If they've been internally generated, then generally we don't recognise those for financial statement purposes. However, when the parent entity acquires a subsidiary, they can recognise identifiable intangible assets of the subsidiary that were previously not recognised by the subsidiary, and they'd be recognised at fair value. Okay, so you've got to appreciate that. Now, the other point to be made is the subsidiary might be reporting its assets, say, at cost. We will have to do fair value adjustments. So we bring across the fair value of the assets we acquired, not their carrying amount. So we might need to do adjustments, fair value adjustments, before we work out goodwill. Again, goodwill is the difference between the fair value of what I paid and effectively the fair value of what I got in terms of the identifiable assets and liabilities. If we don't work out fair values, we can't work out goodwill. And again, only purchased goodwill shall be recognised. So the subsidiary, even though we know there's goodwill in the subsidiary that we're acquiring, the subsidiary is not allowed to recognise that because it would have been internally generated. However, when the parent entity acquires the subsidiary, then that's purchased goodwill, which can be recognised. Now, goodwill shall not be revalued. Okay, the accounting standards prohibit that. They're not subject to ongoing amortisation, but you must do ongoing impairment testing. Okay, so that's important. Now, what are the steps? So you've got to read through the chapter carefully. How do we actually consolidate the accounts of the different entities? Now, you'll see that we use a worksheet, a consolidation worksheet, and we use a consolidation journal. We are not, and I emphasise, we are not doing any adjustments in the ledger accounts of the separate legal entities. We're not touching the parent entity's accounts. We're not touching any of the subsidiaries' own legal accounts. We're doing this outside of those. We're doing these in a consolidation journal, which we post to a consolidation worksheet. So that's an important point. We're not touching the accounts of the individual companies. Now, what we're effectively doing when we consolidate subsidiaries' accounts with the parent entities is we will substitute the investment account for the assets and liabilities of the subsidiary. Now, how do we do that? Well, effectively, we eliminate the investment in the subsidiary against the pre-acquisition capital and reserves of the subsidiary. And at that point, we'll either recognise some goodwill, typically, but as the chapter discusses, at times you'll also, in limited occasions, there might be instead what we call a bargain purchase on acquisition. But again, what we do is we substitute or we eliminate the investment in the subsidiary against the subsidiary's pre-acquisition capital and reserves. And again, from a common sense perspective, you can't have an investment in yourself. So, if you had the economic entity now with one group of financial statements, you can't have investments within organisations within that economic entity. It wouldn't make sense. So we eliminate the investment against the pre-acquisition capital and reserves. Now, again, we must make sure that the assets and liabilities of the subsidiary are at fair value. So before we do these eliminations, so we might need to do revaluation adjustments. And as I said before, if there's some unrecognised, identifiable, intangible assets, we must recognise those before we eliminate the investment account against the pre-acquisition capital and reserves. So we must do revaluation adjustments and also think about whether there's any unidentifiable intangible assets that haven't been recognised. Now, you've got to again appreciate that consolidation adjustments are done in a consolidation worksheet. We're not touching the ledger accounts of the individual entities. So these things don't carry forward. So each year we have to redo elimination adjustments and so forth. So if we do a consolidation after the date of the original acquisition, we still go back and eliminate the investment against the pre-acquisition capital reserves. Yeah, we might have acquired this subsidiary 30 years ago. When we do the consolidation now, we still go back and effectively do the same entries. So nothing carries forward. So again, read through the chapter slowly. It can be a bit tricky, but because when we hear about organisations, they are talking about the consolidated financial statements. So when the television talks about this, or the newspapers or the radio talks about this, they're talking about consolidated financial statements. So it's important you actually understand how are those financial statements put together? What do they actually represent? Okay, so read it. As I always say, have fun. Now, the tip for today, I'm about to go off and do some mowing. This is a noisy machinery. The tip is, if you're using noisy machinery, use some sensible ear protection. Okay, it's good for your health. And I think it looks pretty stylish too. Anyway, that'll do. Bye for now.